Gentlemen, good morning to you both. Samir, I'll start with you. I mean, we did have this hot inflation read, right? Fastest pace in almost 40 years, and yet equities are higher, treasury yields are ticking lower. Was this already priced into the market? How do you see this, I guess, adding to or shifting, if it does at all, your investment thesis as we go into another year?
It was somewhat expected, and that's why you are seeing, especially the long end of the bond curve, start to do well in terms of yields falling and prices rising. This is kind of the market giving the Fed a green light to start to begin to raise interest rates. And what they're basically telling the Fed is you're on the right path with respect to tapering a little bit faster and at least thinking about rate increases, because that long end of the curve is probably the part that's most sensitive to inflation expectations. And so the fact that it's doing well tells us that the market was ready for this.
Keith, do you see it the same way? The market giving the Fed a green light here?
Well, first, good morning. I think the way I look at this is, markets are all about expectations, and this came in relative to expectations. And there were some whisper numbers that it could be even worse. So I think that's why the market so far has reacted okay. As far as the more direct question on the Fed, this definitely allows them to move forward with even a more accelerated taper. I will say, though, right now the market's starting to price in 3 rate hikes. We think that's too aggressive, especially where you consider with the 10-year below 150. If they want to preserve any type of yield curves, I think they're going to go at a more cautious pace. And I think 6 months from now, while inflation will likely stay somewhat elevated, it will start to decelerate as we go lap over year comps.
So, Keith, then how should investors be positioned next year?
Our view, we've been very bullish over the last 2 years, and we're still positive, but we're also realistic that after this big bull market, after we've seen this rebound in valuations and earnings, that we're going to just grow at a more modest pace. But as we look at next year, as far as position, we still are favorable on equities relative to fixed income and cash. From a sector strategy, we have more of a barbell strategy because we think we're going to have this kind of back and forth between, is the Fed going too fast or too slow? New variants come in. So we like areas like technology, which is doing well today. And then we also like cyclical areas like energy and financials. Definitely like the U.S. as the big blue chip country and see that as more favorable relative to international. And we're more negative on emerging markets as we head to next year. And we've been more negative this year in general.